2:20 a.m. Universal Time Coordinated this morning, Bitcoin touched $81,257 in Asian trading. That's a level it hasn't seen since May 15th, 3 months ago. Most people covering this are calling it Bitcoin's comeback. That's not what it is. And the thing that actually confirms what it is happened somewhere nobody's pointing a camera at: the gold market. Let's walk through what actually happened because it directly answers the question we left open yesterday. Quick recap of where we left off. The Treasury doubled its long bond buyback size, yields dropped, Bitcoin ripped from $64,100 to $69,500 in hours, and the open question was whether that was real capital rotating into Bitcoin, or just a short squeeze that would fade the moment leverage reset. Here's the data from the 6 days since. Monday, August 24th, Bitcoin closed at $78,964, up 1.56% on the day, after a fresh $1.14 billion cascade of short liquidations. By early Tuesday, today, it pushed to $81,257, up as much as 2.9% intraday. The 7 days through Sunday delivered a 23% weekly gain. Bloomberg is calling it the biggest weekly jump in roughly 3 years. Other trackers put the 8-day move as high as 28%, depending on exactly where you start the clock. Either way, this is not a one-day pop. It's now a 6+ day trend. The number that tells you this isn't hype: sentiment. The crypto fear and greed index sat at 41, literal fear, a week ago. This morning it's at 74. Greed. That's one of the fastest sentiment reversals you'll see on that index, and it happened in exactly the window this rally has been running. Now here's the part almost nobody's connecting. While Bitcoin was making this move, gold was doing the same thing. Gold pushed above $4,600 intraday this week, extending its own strong run. Bitcoin and gold rallying together at the same time isn't a Bitcoin story and a gold story happening to overlap. It's one story. Traders call it the debasement trade. When confidence in the dollar and long-term government debt weakens, capital moves into both hard assets simultaneously, the oldest one and the newest one. Reporting this week attributed the move directly to that mechanism. Treasury yields easing on the expanded bond buybacks, combined with rising concern about U.S. fiscal policy. That distinction matters more than the price action itself. If this were a Bitcoin-specific story, a new ETF, an institutional filing, a regulatory win, you'd expect Bitcoin to move alone. It isn't moving alone. It's moving with gold on the same macro trigger in the same week. That's the signature of a capital rotation, not a crypto-specific news cycle. It's also exactly what you'd expect if yesterday's Treasury mechanism is still the dominant force in this market, not a one-day technical accident. Here's what the numbers looked like as of this morning for the record. Bitcoin trading around $80,500 in a 24-hour range of $78,553 to $81,240. Trading volume near $60.76 billion. Total crypto market cap at $2.75 trillion, up 2% on the day. Bitcoin's share of that, its dominance, sits at 58.1%. Ethereum's at $2,482, up modestly. Solana's outperforming at $98.56, up over 3%. Reports this week also pointed to accelerating net inflows into spot Bitcoin ETFs, described as the strongest expansion in months, though exact daily inflow figures weren't independently confirmed at the time of writing, so treat that as a directional signal, not a hard number. Here's where you need to slow down instead of getting swept up. Bitcoin is still well below two levels that matter. Its January 2026 high of $94,820 and its all-time high near $126,000 set in October. So 3-month high is accurate, but it's not new high. This rally has recovered lost ground. It hasn't broken new territory yet. And a fear and greed reading of 74 is not neutral. Historically, readings in the 70s plus zone are when rallies get stretched and pullbacks or sideways consolidation become more likely, not less. Greed at the top of a 6-day, 23% plus move is normal. It's also exactly the environment where late buyers get the worst entries. So here's the honest answer to yesterday's open question. Is this real demand or a squeeze? Both, and the mix has shifted. The initial move on August 19th was mechanically a squeeze. Leveraged shorts got forced out. But 6 days of continuation, confirmed by gold moving in the same direction on the same macro trigger, is no longer just a squeeze artifact. Squeeze is clear leverage in hours, not a week. What's kept this going past the squeeze is the underlying debasement trade thesis, actually holding, yields staying lower, fiscal concerns staying elevated, capital continuing to rotate into both hard assets. What this means for how you trade the next 2 weeks. The catalyst hasn't changed since yesterday. It's still the bond market, not a crypto headline. Watch the 30-year yield and gold side by side with Bitcoin. If that correlation breaks and Bitcoin keeps running alone, that's your signal the move has shifted from macro-driven to speculation-driven, and speculation-driven legs are the ones that give it all back fast. And with sentiment already at greed, this is a moment to be sizing new positions carefully, not chasing the number on the screen. $80,000 was resistance for 3 months. Whether it turns into a floor or another rejection point is the actual trade here, not whether Bitcoin is back. So tell me what to dig into next. Do you want me to track whether Bitcoin actually holds above $80,000 as support over the next week, or rejects back into the $70s? Do you want a full breakdown of the gold-Bitcoin correlation and what it's historically meant for both assets when it holds versus breaks? Do you want me to pull the actual daily ETF flow numbers once they're confirmed, instead of the directional reporting I flagged today? Or do you want me to revisit strategy's position now that Bitcoin's another $5,000 above their cost basis, and see how the market's pricing that risk differently than it was last week? Drop it below. That's what decides the next video. I'm Emma, and this is Emma Market Updates.